Hello there, AT&T employees, and welcome. Thank you so much for being here today. I'm Sam, and I moderate these weekly presentations. And in just a second, we're going to be joined by Tyson Mayvar, one of our AT&T focused advisors here. Tyson is going to be giving you a rundown of how the current interest rates affect your AT&T pension payout when you decide to retire from AT&T. I apologize in advance. We don't have time today to answer any questions, but please, I encourage you to ask away in the Q&A box. It's completely anonymous, and I'll make sure one of our AT&T focused advisors can address those questions with you either through phone or email after this webinar has ended. You're going to see some links popping up on your screen. Those will be from me. They are links to our calendar. We can book an appointment with one of our AT&T focused financial advisors. There'll also be a link to our LinkedIn as well as our YouTube. Please follow us on YouTube. We post tons of AT&T related retirement content weekly. We really think you'd get some value out of following us there. And as a quick reminder, we are not affiliated nor endorsed whatsoever by AT&T. We are a completely independent group of financial advisors here, so please keep that in mind as you're listening along. And with all of that out of the way, let's get the presentation started with Tyson Mayvar.
Good afternoon, folks. Thank you for attending our webinar series today. My name is Tyson Mayvar. I'm one of the AT&T focused advisors here at the Retirement Group. Today's webinar series, we're going to cover specific issues on the AT&T pension plan that we find to affect a lot of our clients from AT&T. And fortunately, we have just been made aware of the new interest rates that will affect lump sum payouts for 2025. So I'll go over the new interest rates that came out recently, how that's going to affect lump sums at the turn of the year on January 1st, especially for those of you that are close to retirement. This is a very critical issue to be paying attention to, not just as you approach retirement, but for some of you that don't take your pension right away, which many of you don't have to at AT&T, something you really want to pay close attention to after you leave the company if you choose to defer the election of your pension. So first, before we get into the AT&T pension, it's important to know that age 65 is the normal retirement age at AT&T. That doesn't mean that you have to work until 65. In fact, most age penalties have been satisfied by age 55 for most employees. But this is going to be the age at which, for the most important reason, we remember you have to take your pension right away if you retire on or after your 65th birthday. You don't have the option to defer the election of your pension. Whereas if you retire from AT&T before age 65, for most of you, there's some non-management employees that are an exception to this, but most of you will be able to defer the election of your pension. And that is very important in a year like this year where interest rates are going down and lump sums are going up. You have the ability to watch your pension increase if you project that interest rates will be lower at the turn of the year, and that's certainly going to be the case this year. So remember that if you are already 65, you're going to have to take your pension with a benefit commencement date on the earliest available date, which for those of you that are Legacy S employees, SBC, Ameritech, and some others that are on the non-bargain program, that's going to be the day after your retirement. That's the first available commencement date. Most other plans, the first available commencement date is the first day of the month following your retirement. And going forward, the first of any month is going to be the only available commencement date. So just keep that in mind if you're already 65 or approaching 65. Now, the lump sum's been very popular for many years. In fact, managers couldn't even take a full lump sum for the longest time until I believe it was 2016 when AT&T started offering full lump sums to managers. So most employees now have a full lump sum. There are some exceptions if you don't hit your Mod 75 age and service criteria, in which case you'll be forced to take an annuity or may have to defer your pension until a later date. But most employees now have full lump sum. Doesn't mean that it's appropriate for everybody. There's a variety of reasons you might consider one of the annuity options, and we talk about this when we run a financial plan for folks at AT&T. Some of the benefits of the various annuity options, as well as some of the risks of the annuity. If you are considering a lump sum, it's important to watch the interest rates, which we'll talk about in detail today. Although for people that are a few years away from retirement, I encourage everybody to be open-minded about which option they take on their pension, because we don't know what interest rates are going to be in the future. And circumstances can change, warranting maybe a different pension option at a different date. If you have maybe a spouse unfortunately pass away, if your plans to work after AT&T change, there's a variety of variables in this decision. So be nimble, be open-minded on which pension option you might consider and run the numbers several different ways so you can prepare for a variety of different circumstances. Now, if you're taking the single life annuity, this is going to be the largest monthly payout of all the various annuity payout options. The joint annuity, of course, is going to require you to receive a discount on your annuity because it's multiple lifetimes that the company is guaranteeing income for. The single life annuity can make some sense for folks that maybe are expecting a long life, fairly healthy at the point when you're leaving AT&T. If beneficiary considerations are not important to you, if you're not needing to leave money to anybody or wanting to leave money to anybody, annuity can make some sense. And for those of you that are ultra conservative, that just do not like or can't stand fluctuations in the value of your portfolio, of course, you'll always see those with your 401k plan. But with the pension, this is a way to at least know what you're getting. Now, there are some risks to this, of course. Inflation being the biggest one lately that I see as a reason people are taking the lump sum, because the annuity options are fixed. There's no cost of living adjustment on these, and the higher inflation goes throughout retirement, the bigger there is a risk that your purchasing power is going to decline on what AT&T is paying you in your pension. There's some other risks. More and more people are coming to us with concerns that the company has changed a lot and maybe it won't be around for another 30 years to provide the income that they're hoping for. Now, there is PBGC insurance on the AT&T pension, but if the company happens to sell off the liabilities similar to how they did with Athene several years ago, that PBGC insurance goes away, and there are other considerations there. So these are some of the bigger reasons I see people leaning toward a lump sum, those that plan on taking a lump sum, and the bigger one being death benefit considerations, flexibility to give the money to the kids, or having more flexibility in how the spouse receives a benefit should he or she outlive you, the employee or the retiree. So a variety of reasons you might consider a lump sum, but the annuity makes sense for a lot of people still. The joint annuity, similar in that it's a lifetime payment, but instead of for one life, for two lives. And typically this is going to be for you and your spouse when you retire. You are going to receive a discount as a result of that longer life expectancy for two individuals compared to one. And there's a variety of different joint survivor options. For instance, if you take the 100% joint survivor, you're going to get less money than if you were to take the 50% joint survivor, because there's going to be no change in income for your spouse or for your joint annuitant once you pass away. As opposed to the 50% survivor, you get more money during your lifetime, but your spouse or your joint annuitant will receive a 50% decrease in what you were getting if they outlive you. So the income will go down. And every family is different. If your spouse doesn't have a pension, you might opt to take a higher survivor amount. Or if your spouse, maybe they're much younger. There's a variety of circumstances why you might consider a higher or lower survivor amount, but are happy to help you with that when we run your retirement analysis and talk through some of the important considerations. Now, when it comes to the lump sum, the way that AT&T calculates this lump sum is using both interest rates as well as your life expectancy. The younger you are, all things held equal, the more lump sum you're going to get from the company. Now, there are age penalties if you take your pension prior to age 55 in many cases, but if we compare somebody whose stats were all the same salary, same years of service, but a 60-year-old versus a 55-year-old, the 55-year-old is going to have a lot higher lump sum because they have a longer life expectancy. Similarly, interest rates have an effect on the lump sum, and the higher interest rates go, the less the company has to give you as a lump sum. And they don't change these interest rates but once per year, and they do that on January 1st. And the way that they change the interest rates and pay out lump sums is based on something called a look back period. They're going to look back to the November corporate bond interest rates of the year prior to your benefit commencement date. So here we are in 2024. If you retired and took your pension, you commenced your benefit this year, your lump sum would be calculated using last November of 2023's interest rates. If you retired this year and waited to take your pension, assuming you had the ability to, remember not everybody has that option, but if you retired, let's say now, and waited till January 2025 to take your lump sum, they're going to base your lump sum payout off of November 2024 interest rates. Assuming those rates were lower, it's likely you'd have a higher payout on your lump sum. Now, I will mention here, there's a caveat. Those of you who are on one of the cash balance programs, if you are Bell South Heritage, if you are a singular employee or on the mobility pension, and there's a few other pensions that have this relationship with interest rates won't change your lump sum at the turn of the year, but they do affect the crediting, meaning that if interest rates are higher, you're actually going to get higher accruals on your pension going forward. So it's important to understand which pension you're on, and we'll walk you through the net benefits website if you're not sure, and also educate you on some of the details related to that pension. But what we found, as the interest rates have just recently been published for November finally, is that interest rates will be going down. I'm going to zoom in here. In 2025, there's going to be lower interest rates, which are going to produce higher lump sums for all of the defined benefit pension plans at AT&T. You can see we have all of the November rates going back to 2017 here. They got pretty low during the pandemic, producing some pretty high lump sum payouts. They spiked up quite a bit in 2022. They jumped up slightly again last year, based off of 2023. And they got quite a bit lower throughout the year, but in the last 2 months, they came up a little bit. And what we are now finding is that all three segments are lower interest rates. And pay closest attention to this second segment rate, the one in the middle here, because that by far carries the most weight in this lump sum calculation. That interest rate is 0.5% lower. And the rule of thumb is that every 1% decrease to rates, we can expect about a 10% increase to your lump sum. That means we're expecting roughly 5% increases to lump sums going into 2025. And the calculator should be updated on your Fidelity Net Benefits website to where you can run a projection retiring today and taking your pension right away versus retiring today and taking your pension next month, for example. And you can see what that interest rate impact is going to do to your lump sum. Could be 10, 20, 30, 40, maybe $100,000, depending on how large your lump sum is and how long you've been with AT&T. But this is good news for folks that were close to retirement or recently retired and planning to take a lump sum. We're expecting some bigger payouts. Here's a chart of what's happened to interest rates going back to 2014. You can see that pandemic drop to rates. It used to be that these three segments had a bigger spread. You could see it was all the way from 1.5% up to 5% back in 2014. But we've seen them converge recently, and we even had what we call an inverted yield curve where longer term rates were lower than shorter term rates, interestingly enough. So they're all right about 5%. It's producing lower lump sums certainly than we saw in 2021 and 2020. But we still see a lot of people taking the lump sum, and part of that, like I mentioned earlier, is concern for inflation, or the flip side of higher interest rates. Even though you get a lower lump sum, now you can invest that money in safer asset classes like bonds, CDs, money markets, annuities even, and that side of your portfolio is going to earn more interest than it was just 3 years ago when interest rates were lower. So we still have the lump sum making sense for a lot of people, but the annuity should not be overlooked and needs to be considered. We believe in everybody's decision-making process as they approach retirement from AT&T, but at least we're seeing a little bit lower interest rates going into next year. Now, when you take a lump sum from AT&T, like I mentioned, not everybody has to take it right away. You could defer the election. There's a variety of reasons you might do that. If interest rates are falling, maybe you just haven't figured out what to do with that money, who you're going to hire to help you with that. If you're planning on working with an advisor, which is a big decision for a lot of people. We encourage people to start that evaluation process well before you retire, ideally. We'll even open small accounts for prospective clients before they retire in an effort to get to know them and allow them to get to know us to see if it's a good fit for doing business once they do get to retirement. Typically, when you take that lump sum, you want to elect to roll it over to a qualified retirement account, such as a traditional IRA. That's where most of our clients have most of their money, either at Schwab or Fidelity. We manage money at both companies. So a lot of our AT&T clients like Fidelity. You can still keep your money there and work with us. We also use Schwab for folks that didn't happen to like Fidelity. That's an option. In a traditional IRA, It is also possible to roll over your pension lump sum into your 401k. In most situations, if you're over the required minimum distribution age, you're going to have to start taking money out of that account. And there's a few reasons that we would recommend that, especially if you're under 59 and a half, you might want to roll that money over to your 401k, because a lot of times you can take penalty-free distributions from your 401k, given that you met specific requirements. And that's something we would also want to educate you on if you are not yet 59 and a half when leaving AT&T. But the benefit of the IRAs is that there's vastly more investment options in the 401ks, and that's eventually where most people will end up rolling over their 401k and pension, assuming they're comfortable with the person that's helping them manage those investments to protect their wealth as well as grow their investments at a rate that's going to at least keep up with inflation and not have them losing purchasing power over their retirement years. Now, we often liken the pension lump sum conversion to a mortgage, because a lot of people ask us, why, when interest rates go up, does my pension lump sum go down? The reason is present value calculations, but the easiest way to think of this is if you have a certain budget for a home you're going to purchase, let's say it's $19.50 per month you can afford to spend on a mortgage, and you go to the bank, interest rates are at 4%. Remember those days? They're probably closer to 7% now if you go to get a mortgage, but if interest rates are at 4% for a 30-year fix, the bank might tell you that your budget for a home is $408,500. That's it's the most expensive home you could buy given those interest rates. Well, if you go back a couple months later and interest rates have fallen to 3%, if nothing changed to the amount that you could afford monthly for a home, all that changes is how much home you can afford. And in that situation, it increases the amount of home you can afford to $462,000 and some change. Similar to the lump sum, with a fixed annuity, which is the default payment option on the pension, when interest rates go up, lump sums go down, and vice versa. Like we're seeing this year, interest rates are going down, so lump sums will be going up for anybody on the defined benefit plan, which is most employees at AT&T, Legacy T, SBC, Pac Bell. Most of the non-management plans are all on the defined benefit pensions, which means you have an inverse relationship with your lump sum and interest rates. Now, unfortunately, what we've seen over the years is that statistically 74% of Americans over the age of 50 don't even have a plan for their retirement. We think this is unacceptable, folks, especially since there's a number of companies, including ours, that will do this for you for free, completely complimentary, in an effort to get to know you and in hopes that you might do business with us at some point in the future. So take advantage of this. It's a completely free analysis. They'll cost to you is some of your time. It might be a 30-minute to an hour in-person meeting or web meeting to cover the details. So let us know if we've never done this for you, if you'd like to take advantage of this, or if it's been over a year since we've updated your plan, let us know. We're happy to do that because there has been a lot of changes to the tax code, to AT&T benefits, and now to the interest rates that affect the pension plans. Here's some of the reasons I think a lot of people like working with us. We have clients going back over 30 years from AT&T, since the early 90s when we opened up shop. We have a lot of clients. If you would like to talk to some of our clients as references to see how we've been doing, we're happy to furnish references. We have over 100 offices around the country, and many advisors like myself who have many clients from AT&T and have seen every mistake in the book that we would like to help you not make if you decide to become a client of ours and work with us after you leave AT&T. So spend some time with us. We're willing to. If you're willing to spend a few minutes with us, let us know what questions you have, if you'd like to do that cash flow analysis, or if you just like to set up a meeting to talk through some of the concerns that you have as you approach your retirement from AT&T. How to reach us, you can email us at info@theretirementgroup.com. You can call us at 800-900-5867. You can schedule a meeting with myself or one of my colleagues through the QR code here on the left. And the QR code on the right will get you to our LinkedIn page where we publish a lot of these webinars that we've done, many specific to the AT&T retirement strategies, some more generic to things like estate planning, Social Security, investment planning, and a variety of different topics that are focused on retirees becoming financially independent. So with that, we're going to wrap it up today. I want to thank everybody for spending some time with us. Hope everybody has a Merry Christmas, Happy Holidays, a good rest of the year, and we hope to talk to you all next year in 2025. Thanks again, folks.